Warren Buffett is an American business magnate, investor, and philanthropist. He is currently the chairman and CEO of Berkshire Hathaway. He is considered one of the most successful investors in the world and has a stunning net worth of over $100.6 billion as of April 2021, which makes him the world's 7th wealthiest person. In this video, we are going to share 5 investment tips from Warren Buffett. 1. Invest in what you know. One of the easiest ways to make an avoidable mistake is getting involved in investments that are overly complex. Many of us have spent our entire careers working in no more than a handful of different industries. We probably have a reasonably strong grasp on how these particular markets work and who the best companies are in the space. However, the far majority of publicly traded companies participate in industries we have little to no direct experience in. This doesn't mean we can't invest capital in these areas of the market, but we should approach with caution. 2. Never compromise on business quality. While saying no to complicated businesses and industries is fairly straightforward, identifying high-quality businesses is much more challenging. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. Some investors might be surprised to learn that the name Berkshire Hathaway comes from one of Buffett's worst investments. Berkshire was in the textile manufacturing industry, and Buffett was enticed to buy the business because the price looked cheap. He believed that if you bought a stock at a sufficiently low price, there will usually be some unexpected good news that gives you a chance to unload the position at a decent profit, even if the long-term performance of the business remains terrible. With more years of experience under his belt, Warren Buffett changed his stance on cigar butt investing. He said that unless you are a liquidator, that kind of approach to buying businesses is foolish. The original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surface. These types of companies also usually earn low returns, further eroding the initial investment's value. 3. When you buy a stock, plan to hold it forever. Once a high-quality business has been purchased at a reasonable price, how long should it be held? Warren Buffett clearly embraces a buy and hold mentality. He has held some of his positions for a number of decades. Why? For one thing, it's hard to find excellent businesses that continue to have a bright long-term future. Buffett runs a concentrated portfolio for this reason. Furthermore, quality businesses earn high returns and increase in value over time. Just like Warren Buffett said, time is the friend of the wonderful business. Fundamentals can take years to impact a stock's price, and only patient investors are rewarded. Finally, trading activity is the enemy of investment returns. Constantly buying and selling stocks eats away at returns in the form of taxes and trading commissions. Instead, we are generally better off to buy right and sit tight. 4. Diversification can be dangerous. In my view, individual investors gain most of the benefits of diversification when they own between 20 and 60 stocks across a number of different industries. However, many mutual funds own hundreds of stocks in a portfolio. Warren Buffett is the exact opposite. Back in 1960, Buffett's largest position was a whopping 35% of his entire portfolio. Simply put, Warren Buffett invests with conviction behind his best ideas and realizes that the market rarely offers up great companies at reasonable prices. 5. The best moves equals boring. Investing in the stock market is not a path to get rich quickly. If anything, I believe the stock market is best meant to moderately grow our existing capital over long periods of time. Investing is not meant to be exciting, and dividend growth investing in particular is a conservative strategy. Rather than try to find the next major winner in an emerging industry, it is often better to invest in companies that have already proven their worth. Many companies that boast long and successful corporate lives provide basic products and services: snacks, beverages, toothpaste, medicine, convenience stores. We often make investing harder than it needs to be. Buffett follows a simple approach rooted in common sense. By embracing some of Buffett's investment advice, focusing on the longer term, sticking to blue-chip dividend stocks, remaining within our circle of competence, we can better manage our portfolios to reduce the number of costly errors we make and continuously move closer to achieving our goals. Hope this video and Buffett's advice will help you in your journey. Subscribe to Financial Data for more exclusive content.